Do not refinance your mortgage if your loan estimate looks anything like this, as you could be making one of the biggest financial mistakes of your life. In this video, I'm going to tell you why refinancing your mortgage might cost you way more than you think. Traditionally speaking, refinancing your mortgage isn't free, and a lot of times lenders often downplay or even hide the true cost of refinancing to make the savings look greater than they actually are. So I want to spend a little time and talk about the things that you should be paying attention to if you're considering refinancing your mortgage. Now, just a moment ago, I put a loan estimate on the screen that had a couple of areas with red circles drawn around them. And that's exactly where I want to start today's video. If you are considering refinancing your mortgage, there's really two areas of the loan estimate that you absolutely have to pay attention to. And the first of those areas is box A on the loan estimate, as this area will show you all of the fees that your lender is charging you in order to do the loan. Now, you've probably heard of paying points when it comes to refinancing your mortgage. And what a point is it's basically 1% of the loan amount, or a fraction thereof. But with that said, a lot of times a lender will tell you that there's absolutely no points on the loan, but there's still fees in box A. Well, please understand, regardless of whether they're calling them points or calling them something else, anything in box A is essentially a charge to you being paid directly to the person doing your loan. So whether you want to call it an origination fee, an application fee, or just a processing fee, all of those fees are fees that are being charged directly to you. And at the end of the day, these fees will impact your bottom line. Now, the next area on that loan estimate that I want you to pay attention to is area J. And the reason I want you to pay attention to this area is because if your lender is giving you a credit towards your closing costs, then this is where that's going to show up. So for example, I recently refinanced my mortgage, and I've told you that I was able to refinance my mortgage with absolutely no cost out of pocket. And the way I was able to do that is because my lender gave me a credit to apply towards those closing costs. Now, in the case of my loan, I actually paid some fees in box A, which I was completely okay with because those fees were being offset by that credit provided in box J, which actually resulted in me having to pay absolutely no fees out of pocket in order to do my refinance. And the way I was able to do that is because I took a slightly higher interest rate than the par rate, than the best interest rate out there in the market. And in turn, it paid a yield spread premium that the lender could actually pay back to me that ended up covering my costs. Now, later in the video, I'll talk about why I paid a slightly higher interest rate to get that credit. But the next area that I want you to pay attention to is the bottom area there where I have two different areas circled, which is essentially calculating the cash to close on the transaction. And the reason I want you to pay really close attention to this is because this is where it shows your new proposed loan amount versus the payoff on your existing loan. And you'll notice in the example that I have here, it's almost $9,000 higher than the payoff on the mortgage, which shows you that the lender is actually raising your loan amount and building the cost into the loan so that you're not having to bring any money in at closing. And oftentimes this can be overlooked because you're focused on the savings in the loan. Most people live in the payment and not the price. So if a lender tells you, hey, they can drop your interest rate from 6.5% down to 6%, and they can save you a couple of $100 a month, most people don't go through the loan estimate with a fine-tooth comb. And this is where I would tell you to stop and make sure you're paying attention, because this is where lenders can hide the cost of what they're charging you in order to do that refinance. So by doing this, not only are you increasing your loan balance, essentially giving your equity away, but you're also increasing the amount of interest that you're going to pay over the life of that loan. So please make sure before you refinance your mortgage, you fully understand what you're paying. Understand how much you owe on your current mortgage. Understand how much they're proposing your loan amount to be, because even though you might be saving money on your monthly mortgage, doesn't necessarily mean it's a good deal. And one of the reasons for that outside of the cost is you could actually be resetting your loan term. Traditionally speaking, most people go with a 30-year fixed mortgage, especially over the last couple of years, as the 30-year fixed mortgage has been priced more aggressively than adjustable rates. But here's the catch. Say you've had that mortgage that you currently have now for 2 years, and then you go to refinance that mortgage. Well, a lot of times what'll happen is when you talk to that loan officer on the other end, they actually decide on your behalf to put you back into another 30-year fixed term versus starting you where you left off at 28 years. Actually, my lender said something to me the other day that really stood out. He said that most borrowers out there that are refinancing are actually being told what they're going to get versus being asked what they actually want. And that's exactly what I mean by putting you back into a 30-year fixed term. A lot of borrowers don't know that they can go into a shorter term loan. loan and continue paying their mortgage off in the same period of time. But one of the sneaky ways that a lender can make your savings look greater is by financing you back into that longer term. So not only are you going lower in interest rate, but they're also extending the term of that loan, which in turn makes your savings look greater. But here's the thing, you could be actually extending that mortgage debt that you plan to pay off in 30 years before you retire. You could instead be putting yourself at risk of still having mortgage payments into retirement years, which can be financially disastrous for those on a fixed income. So instead of just calling a lender and telling them that you want to lower your rate, that you need a lower monthly payment or that you need cash out, rather ask them what they suggest to put you in a better financial position to save money. Because it's like walking into a car dealership and telling them that you need a certain monthly payment. Because guess what? You're going to walk out with that car at that monthly payment, but here's the catch. They're going to take that standard 4 or 5 year loan and extend it to 7, 8, 9 years, and it's likely going to have a super high interest rate on it as well. And because most people live in the payment and not the price, they're just paying attention to the price. They're not paying attention to how much money they just paid, how much interest they're going to pay over the life of that loan, or how much of their equity just got eaten up by closing costs. So just make sure when you're going through that process, you're working with a professional and not someone you just found online. And one other thing I want to touch on when it comes to interest rates is understand just by going lower in interest rate doesn't necessarily mean you're saving money at the end of the day. What you have to do is factor in how much it's costing you to do that loan. Now, if you're like me and the lender's giving you a credit to cover your costs, which if that's an option for you, that's what I would suggest. And the reason for that is because I do believe interest rates are going to continue to move down over time. That's one reason that I would avoid paying points. I would avoid paying a lot of fees in order to refinance my loan, because chances are you're going to get another opportunity in the future. And the last thing you want to have is a bunch of sunk cost on your loan. And that's exactly why I took a slightly higher interest rate on my loan, so that I could get that credit back from the lender to apply towards my closing costs. So yeah, I'm paying a slightly higher interest rate than I could have gotten on that same day, but I walked out of that mortgage not having to pay any fees out of my pocket, which means the next time that interest rates move down, then I can actually take advantage of it without having to second guess whether or not it makes sense because I paid X amount for closing costs. But with that said, if you are somebody that's paying costs on a loan, try to avoid discount points, try to avoid buying down your interest rate unless you're at a point in your life where you're not going to be able to refinance next year because maybe you're retiring or you're not going to have the income or whatever. If you're somebody where everything is going to stay the same and essentially you can refinance in the future, don't pay points, because by paying points, you're going to have those sunk costs, as I mentioned a moment ago. But here's the thing, if you do have fees, say you have title and escrow fees and fees associated with your loan, then here's what I want you to do before you actually move forward. I want you to take how much you're saving on your mortgage, how much is your payment going down, then I want you to divide it into your actual closing costs. And that will tell you how many months you need to keep that mortgage in order for that refinance to actually make sense. Now, if you're somebody watching this and you're calculating it and it's telling you 5, 6 years to recoup that cost, then I probably wouldn't refinance now. In fact, do not refinance now. Instead, you should wait until that recoupment period is probably less than a year, maybe even 6 months, because I do believe interest rates are going to continue to move lower. Refinancing is often sold as a way to lower your monthly payments, but for many, it's just a temporary solution to deeper financial issues like excessive debt. And that's why oftentimes you'll get a lender trying to push a cash out refinance so that you can pay off debt and ultimately lower your overall expenses on a monthly basis. But here's what I'll say about that. This is often a short-term relief. A lot of people that I see that pull cash out of their property to pay off debt end up doing it again and again. And that's often because they have other financial priorities that refinancing and pulling cash out can't really solve. It's just a temporary solution. And understand, by doing this, you could be putting yourself at risk of losing your home. If values pull back at all and you continue to pull equity out of that property, you could ultimately be setting yourself up for financial disaster. So if you are somebody that is considering refinancing, whether you're pulling cash out or just doing a rate and term refinance, please make sure you pay attention to box A in the loan estimate, as we mentioned earlier in the video. Pay attention to what fees you're being charged. Pay attention to your loan amount. How much is your loan amount actually going up? Because a lot of times those costs will be rolled into the loan and it's never even discussed. And the last thing I want you to pay attention to is your loan term. How much are you adding back to the term of your loan when you're going through that refinance? Now, if you watch this video and you have no idea where to start, you're considering refinance, you want to work with a professional, maybe you're going through the process and you want a second opinion, well, my team and I would love the opportunity to help. You can actually reach us using that link in the description of this video, and we can not only show you exactly how much you'll be saving, but they can discuss your goals and go over everything with you so that you can make the best decision for yourself. And with that, I'd love to hear some of your stories about refinancing recently. What have you gone through in the process? Let me know by leaving a comment below.